So a quick soundbite about Kernel. At Kernel, we believe every one of you is unique. You've got your own goals, financial situations, your own family situations. So the foundations for financial success need to support that. So for us, investing is about making sure that you have the choices and flexibility to invest towards your own goals. So that meant creating a wealth platform that's accessible, and also meant reimagining index investing in New Zealand. So we've started locally. It's a market we know well. We saw there was an opportunity to give you as investors more choice and more value. So we've launched 3 New Zealand index funds. I encourage you to check out our website. You can find all the information you need about them. I won't go into detail tonight, but feel free to ask us questions after. I also encourage you to go and check out the blogs. Our team are regularly posting and talking about investing and the market. And part of what we do at Kernel is try and bring global innovation locally. So we partner with people like S&P Dow Jones to bring some of that global market to the New Zealand scene. So for the past 8 months, we worked closely to develop a new index. That new index is what we track with our Level 9 fund. It becomes the first fund for retail investors in New Zealand to now access investments outside of the top 50 companies in New Zealand through an index fund. Finally, the reason we're all here tonight for our first investor evening is to talk about index investing. For us, it's something we're really passionate about, as we believe it gives you as investors the best chance towards achieving your long-term financial goals. So we've got a guest speaker tonight, all the way from New York, Craig Lazzara. Craig is from S&P Dow Jones. So S&P Dow Jones are a leading global index provider. All of our funds track an S&P index. Every day, S&P calculates over 1 million indices, and Craig and his team are responsible for distilling that information into actionable insights. So tonight, Craig is going to share some of those insights about index investing, and hopefully by the end of it, you'll understand exactly why we're so passionate about index investing.
What has happened is that over the course of the past 50 years, index funds have come to account for roughly 25% of the total value of assets invested in the U.S. market. Or another way to say that is that 25% of the capitalization of the U.S. market is invested in index vehicles. And it was zero 50 years ago. I mean, all of this happened within, some of you are younger than I am, but all of it happened within my lifetime, certainly. And it's really quite an extraordinary development in the history of modern finance. Why did it happen? That's what we're really going to talk about, is what is it that impelled money to move the way it has done? And the short answer is index growth was spurred by the disappointing performance of active portfolio management. Now, there's a lot of literature on this. These numbers are from a study that we call SPIVA, S-P-I-V-A, stands for S&P Index versus Active. And what SPIVA does, or SPIVA tries to do, is to measure the performance of a database of actively managed funds and ask the question, how many managers outperform a benchmark that's appropriate to their investment style, how many underperform? So these are the numbers for calendar 2018 in the US, and as you can see, about 64% of the large cap US managers underperform the S&P 500. A little bit better result for mid cap, a little bit worse for small cap. If you go back 5 years, or for that matter, if you go back 10 years, the results are worse than the single year results. SPIVA has run in the US since 2001, and you can see the results that I reported a moment ago for calendar 2018 were very typical. Roughly, on average, maybe 65% of managers underperform the S&P 500. Of the 18 complete years of data we have, in 3 years, the majority of active managers outperformed. In 15, the majority underperformed. So it's a tough record in the US, and in fact, if you look globally, the results are very similar. Wherever we can find a sufficiently robust database of fund returns, we try to do a SPIVA report. Now, sufficiently robust, I'll tell you a trade secret, involves something called survivorship bias. What survivorship bias means simply is, if we look today at the returns of funds that have a 10-year track record, you're looking at funds that were good enough to survive for 10 years. All of the funds that existed 10 years ago aren't here anymore. And your database has to reflect that, which is no easy thing because you have to keep very good records and good historical records. Nonetheless, where we can find a good database of fund returns, we will do a SPIVA report. And where we find SPIVA reports, we find a very, very similar result. The majority of managers underperform most of the time. It's a corollary to SPIVA. I don't think we brought the data on this slide deck. It's a corollary to SPIVA. People often ask, well, it may be true that the majority of managers underperform. Isn't it true that there can be some managers who consistently do better than average? And it is certainly, there's no theology that prevents that. It's certainly possible that that should occur. But if you look for evidence of it in the data, it's not there. Typically, when you see success historically for active managers, it is not predictive of future success. So the message of SPIVA and related studies is the majority of active managers fail most of the time, and when you see success, it doesn't tend to persist. Now, this is surprising to me because active managers are smart people and they work very hard and they are well trained and well educated and they have tremendous financial incentives to do well. Why is it that they have such a difficult time succeeding? And there are four answers to this, or there maybe more than four, but four big ones that we'll discuss tonight. And they're sort of in order of importance: professionalization, cost, skewness of returns, which is kind of a technical thing, and then factor indicization, which we'll talk about at the end. So let me start first with professionalization. What I mean by professionalization is simply that there's no natural, I use the term alpha here, very imprecise. It's a technical term in investment analysis. There's no natural source of outperformance. What I mean by that is if all of us in this room, or all of the investors in the New Zealand stock market, if I'm going to be above average, one of you is going to be below average, maybe more than one. Some of it has to be below average because the average of all the investors' holdings has to equal the return of the market as a whole. Another way to say that is if this side of the room is everybody who's done better than the index, the weighted average sum of the outperformance of this side of the room is exactly equal to the weighted average underperformance of all of the losers over here. There's no source of return, of excess return for the winners other than the underperformance of the losers. Now, when you think about the evolution of financial markets, the critical variable is the thing we've identified in the third bullet point here, the supply of what I call here undiversified amateurs. Now, that sounds like a pejorative term, and I don't mean it that way at all. My grandmother, God rest her, was an undiversified amateur. She owned two stocks, both utility companies, paid regular dividends, all of her life, all of the life that I knew her, and she was perfectly happy with that investment philosophy and that investment portfolio, and she was therefore she and 30 million like her were a source of potential outperformance for every professional investment manager who was underweight utilities. That's what I mean by undiversified amateurs, people who don't own index portfolios and aren't in the investment business. Now, if the amateurs are, let's say, 80% of the market, conceivably all 20%, all of the professionals theoretically could outperform because the underperformance of the 80% amateurs is enough to fuel the, I mean, in practice it wouldn't be all of them, but theoretically it could happen. Whereas when the numbers shift and when the market becomes 80% professional and only 20% amateur, then there aren't enough amateurs to go around. The professionals end up competing against each other, and instead of being able to exploit, the professional being able to exploit a position of superior knowledge, easier trading, better access to information, he's competing against someone who has the same advantages as he does himself. That's why, parenthetically, indexing started in the 1970s. You think, why not 20 years sooner or 10 years later? Because by the mid-1970s in the US market, professionals had come to dominate. In fact, there's quite a well-known article called The Loser's Games, published by a man named Charles Ellis in 1975, I think. It was the history of post-war investment management. And he said, 20 years ago, it was hard, it was easy. It was easy. The professionals had substantial advantages over the relatively large group of amateurs with whom they're competing. Well, professional investment management grew to the point where the professionals essentially were the market. And at that point, we were unable to have a sustainable advantage for the majority of professionals. That's what the professionalization of the market means, and that's what drove the initial wave of indexation. Now, Important to realize that this is not a one-time process. When funds shift from actively managed to passive, presumably it is the least capable active managers who lose the most assets. The ones who are doing very well, they manage to keep their clients. The ones who are not doing so well are the ones that sustain the biggest losses. What that means is that the presence of index funds raises the level of ability of the active managers who survive. And it's a crude analogy, but it's one I'm quite fond of. The lion catches the slowest zebra in the herd. The lion eats the slowest zebra, the average speed of the herd goes up. The lion gets hungry 2 days from now, it's harder to be an above average zebra. The guy who was second or third from the back of the herd, he's now in much more trouble. And something analogous to that happens with investment managers. Index funds are available, the worst active managers lose the most assets, and now the identity of the worst active managers changes because it gets harder and harder and harder. It's relative skill that matters, and the professionalization of the asset management market is one of the things that's driven the trend toward indexation. Now, the second thing, and better known, I think, is cost. Right? Active management costs more than passive management. In the US in 2018, the spread was about 70 basis points, 0.7%, 70 basis points we call it in the business. That means an average active manager starts out in the hole by 70 basis points. If your fees are higher, the hole is deeper. You have to make more to overcome the costs of your fee. Simple as that. Now, if you can do it, that's fine, but the majority of managers consistently have not been able to deliver that. A couple other comments to make with reference to this. One is that you can use these sorts of numbers to say something about the changing economics of the investment business. I mean, if the difference in fees between active and index is 70 basis points, and there's roughly $4 trillion US indexed to the S&P 500, 70 basis points times 4 trillion is $28 billion a year. That's $28 billion that investors are saving and not paying to active managers. And that has a huge impact. And that, by the way, it's 28 this year, it might be 30 next year. That only counts us, not our competitors. That has a huge impact on the economics of active management. So when you hear active managers complain about the competition from index funds, it's not surprising. It has been severely damaging to their economics. I cited an article here that I recommend everybody. It's called The Arithmetic of Active Management. You can find it on the web by William Sharp, who won the Nobel Prize in Economics in like 1990, I believe. Best article on investment management you'll ever read. 4 pages, 5 pages, no math. It's just wonderful. So I recommend it to anyone who wants to learn a little more about the things we've been talking about. So professionalization, cost. The third thing is a little more technical, and it's not that well understood. So I'll take a few minutes to talk about it. It's the notion of skewness. Okay? It explains. Think of a bell curve. Normal bell curve distribution. Stock returns don't look like that. Now you might suspect that's true because a stock can only go down 100%. It can go up 100, 200, 300. So there's a natural positive skewness, it's called, natural skewness to the right built into the way in which we know that returns behave. And you can measure skew, or you can identify skewness by simply asking, all right, is the median value in a distribution below the average? If the average is bigger than the median, it means there are some really big values pulling up the average number. And this is very common. I mean, if we went through this room and took heights and weights, I'll guarantee you it's skewed to the right. There's some, the minimum height is probably about 5 feet, and there's somebody who's tall is going to pull the average up. It's very, very common. Weight would be the same. I mean, it's very common. But it applies to securities prices as well. If we measure in the U.S., for example, with the S&P 500, I have good data for the last 28 years. 24 of them returns were skewed to the right. In Australia, it's 10 of 18. New Zealand, I have only 15 years of data, 11 out of 15. Japan is something like 22 out of 23. Asia is it's very common. It's not just these three markets. There's a professor in the U.S. named Bessenbinder who published an article a year or two ago. It's kind of gotten a lot of publicity. What he did was something a little bit different, which was to look at the history of the U.S. stock market for the last 90 years He took every public company that's existed in the U.S., ranked them in return from bottom to top, and what he discovered was the bottom 96% of the names. If you add up the return of the bottom 96%, that's Treasury bills. All of the excess return comes from 4% of the names. So really shocking degree. Now, in fairness, of the 96%, probably half of them didn't survive more than 5 or 10 years, every public company in the U.S. But there's a huge degree of skewness, and you observe it more readily when you extend the time period beyond a year. So here's a look at 15 years of data for the NZX 50. The median stock in the one in the middle was up 69%. The average was 201. If I do this graph for the U.S., it looks the same. If I do it for Australia, for Canada, it'd be very, very similar. I mean, the numbers are different, but the principle and the look is the same. Now, what does that mean? Well, what it means is that I don't have any stock selection ability at all. I don't profess to have any, but I have a 50-50 shot of picking a stock that'll be above median next year, because half of them will be. That's not good enough. The task of, in the presence of skewed returns, the task of active management is much harder than we realize. It's not just a matter of picking a stock that's in the top half of the distribution, because the distribution is skewed to the right. And that's one of the reasons that the results from SPIVA and other studies are what they are, is that returns are skewed. And that makes the active management task much, much harder. Now, I want to say a few words about the impact of the growth of indexing on the efficiency of markets, because you hear this complaint very often from active managers, and the active managers' argument is that market efficiency depends on us. You know, if there weren't active investment managers searching for bargains, markets would be inefficient, and that is absolutely correct. I mean, I had a conversation at a conference, goodness, now 5 or 6 years ago, with a fairly well-known professor from the University of Chicago. We're talking about the growth of indexing, and he said, Craig, if 100% of the market were passive, so I want to be the first active manager, because they're going to be huge misvaluations. It's because there are fundamental managers looking at balance sheets and income statements and making projections. That's what makes markets efficient. And efficient in this sense means that the tendency of prices is to seek fair value. Doesn't mean prices are always correct, but it means that the central tendency is to seek fair value. This is true, and active managers will often say unkind things about index funds as a result of that. I mean, the word parasite gets used with distressing frequency. It's very hurtful, actually. But active managers will say, well, index funds are this free ride on the market efficiency. And to a degree, that is true. But there are a couple contributions that index funds make to market efficiency that I want to draw out today. One of them is something we've talked about already. Remember the lion and the zebras. The growth of passive management, the growth of index funds, means that active managers, in order to survive, have to be better. The better the active managers are, the more astute they are, the more efficient prices will be. So simply by providing an alternative to the worst active managers, index funds create market efficiency on their own. That's the first thing to keep in mind. The second thing to keep in mind related to this is to ask ourselves, how is it that active management contributes to market efficiency? The answer is by trading. I mean, if I'm an active manager, I might do research on a company, I might know more about it than anybody else other than the CIO. I might have very strong views about what the proper valuation of the company is. Unless I trade, none of it matters. The only way my knowledge filters into the market and affects what's called price formation is when I trade. Well, that makes it a relevant question to ask, how important is index fund trading versus active trading? And we can model that. It's hard to be precise. It's somewhat hard to be precise about it. We can model it quite easily by making some very simple assumptions. So to do this graph, what we assumed was that the average turnover of index funds was 10% per year. Well, that, by the way, that's far too high. It's really much less typically. But that's a fair assumption because I wanted to be conservative. The second assumption we made was that the average turnover of active portfolios was 50% per year. Now in the U.S. that is way too low. 100 would be closer to correct. But again, I wanted to be conservative in both directions. So if you make those assumptions, you can change the assumptions and make a different looking curve. If you make those assumptions, you can draw a curve like this that relates the percentage of horizontal axis, percentage of assets that are passively managed. On the vertical axis, the percentage of trading that is done by passive managers. So if you say, as we'd estimate, that maybe 25% of US assets are held in index trackers, this relationship implies that maybe 8-10% of all trading is done by index funds, the other 90% is still done by active managers. Parenthetically, or serendipitously, both Vanguard and BlackRock in the last several years have both done studies of this very question. I mean, how big is index trading as a fraction of the whole? And theirs was not a theoretical digression like this. They actually looked at trade data, empirical data, and they both came up with an answer maybe in the range of 5 to, I think, 12%. So this model is not bad as an indicator of how important index trading is. Though ask the question, what happens if index funds double in size? If they go from 25% of the US market to 50, the answer is index trading might be as high as 15 or 20%. Active trading would still be 80 or 85%. So the message of this kind of analysis is that there's a very long runway ahead within which index funds can expand, and active trading is still going to dominate, and therefore active contribution to price formation will still be important. Now, everything we've talked about in terms of trading and price formation so far, price discovery, has been with reference to trading in individual stocks, trading in the components of index funds. It's also important to recognize that as a result of the growth of indexing over the past 50 years, there has grown up I'd like to call it an ecosystem of trading in index-linked vehicles. So for example, in the US, you can easily trade the S&P 500. There are ETFs, exchange-traded funds, there are futures, there are options, there are levered vehicles or unlevered vehicles. There are a huge array of index-linked trading vehicles exist. And recently we tried to measure, strangely enough, I'd never done this before at S&P Dow Jones. We decided we wanted to understand the size of index trading, the magnitude of index trading or trading in index-linked vehicles. And so it's all public data. It's not hard to, well, it's not easy to find, but you can get it. And I didn't have to do it, so for me it was easy to find. But the people who did it tell me it's tough to get. But you do it, and what you discover is something really quite interesting. So the orange-colored bars here represent the S&P 500. Our estimate I mentioned earlier of assets indexed to the S&P 500, about $3.6 trillion, so that US dollars. What was the level of trading, what was the volume of trading in vehicles linked to the S&P 500 in the year ended June 30th, 128 trillion US dollars. So it's order of magnitude bigger trading in index-linked vehicles relative to the amount of money simply held in index funds. Same is true for the Dow Industrial Average. The same is true, we model here the ASX 200, 61 billion held in passive assets, almost 2 trillion traded. This means a couple things. One thing it means is that if all you care about is maintaining 3.6 trillion in indexed assets to the S&P 500, you don't need to trade 128 trillion. The fact that there's that much trading means that active traders, active investment managers, hedgers are using index-linked vehicles in a way that's very, very active. The most frequently traded heavy volume vehicle against the S&P 500 is called the E-mini future. It's a futures contract, trades on the Chicago Mercantile Exchange. The average holding period of an E-mini future is 2 days. I mean, there's lots and lots of very, very active trading. That's the first thing to recognize. The second thing to recognize is that active trading contributes to market efficiency because it lets me express a view as an asset manager. It lets me express my view on the appropriate valuation of the US market, of the Australian market, New Zealand market, Canadian market, whatever I want to express. I have a way to do it. 30 years ago, that wasn't the case. I mean, if I thought the U.S. market was undervalued and I wanted to invest in the U.S., I had to go out and buy IBM and AT&T and General Motors. Now I don't have to do that. I can buy an ETF, I can buy a future that links very directly to the value of the U.S. market, and that is just as much a contribution to market efficiency as somebody who decides based on fundamental analysis to buy a particular stock. The two things relate. The two forms of efficiency relate because there's an arbitrage mechanism that links the value of the market as a whole to the value of the individual components of an asset. So if the value of the S&P 500 future or the S&P 500 ETF goes up as a result of bullish investors, that will be transmitted to the valuation of the 500 stocks. So macro efficiency begets micro efficiency and vice versa. So index funds contribute in that way to the growth of efficient markets. What's next? The final thing I want to show you, because it sheds another light on, well, a number of things. One of them is it's another way of looking at the difficulties that active managers face. It revolves around a concept that we call dispersion. Now, dispersion, from a computational standpoint, dispersion is like a standard deviation. It's a measure of the width of the distribution of a set of returns. And we compute these all over the world every month. There's a dashboard that we issue, so it's very something we're quite interested in pursuing and do pursue. The computation doesn't tell you why it's important. This is an attempt to show you why it's important. Picture of 2 months in the history of the Dow Jones Industrial Average. The red line is the Dow, the gray line is the 30 stocks. And the reason to do it with the Dow is because it's pretty easy to draw 30 gray lines. 500 gray lines, that's not so pretty. But 30 gray lines, that's the individual stocks. In both of these months, the Dow was up 3%. I tell people, 30 years from now, some young analyst is going to come along, yet unborn, and is going to say, these months were basically the same thing happened. The market was up 3% in both these months. Okay, left side high dispersion, right side low dispersion. You see the difference very clearly. If I'm a stock picker, if I'm a good stock picker, and of course all stock pickers think they're good stock pickers, so if I'm a stock picker, I like the left because the range of outcomes is big. The gap between the best performing stocks and the worst performing stocks, and the best performing stocks and the average is big, which means if I'm good at selecting stocks, I have a lot of value to add. Even if I'm legitimately a tremendous stock picker, if I'm in an environment like the one on the right where dispersion is low, it doesn't matter so much. It doesn't mean that I don't have skill. Dispersion has nothing to do with skill, but it has a lot to do with the value of skill. And in a market with low dispersion, skill is worth less, which means that if we look at the history of dispersion for the S&P 500, say, other markets have similar looks. Here's the S&P 500. The long-term average is about 20%. You see the progress over the last 30 years here. The peak was in the technology bubble at the end of the 90s and early aughts. Secondary peak came around the time of the financial crisis. Since roughly 2012, it's been really quite muted. Recent value about 17%. It hasn't gone up, down. This is through the end of last year. It hasn't changed a lot since the end of last year. What does this mean for people who do active stock selection? It means the opportunity for them to add value is less because in an environment like the one on the right, your skill is worth less. If you're in a low dispersion environment, as we've been since 2012, the value of active skill is less. It's harder and harder for active managers to outperform. In fact, to make the connection, it's obvious, if we look at our SPIVA data, the worst year for active managers on record was 2014. Like 85% of all of the large cap active managers underperformed the S&P 500 in 2014. The lowest recorded dispersion level for the S&P 500, would you like to guess what year it was? 2014. By far the lowest, well, not by far the lowest, but certainly the lowest. And what that means, and those two things are connected. The low level of dispersion meant it was harder, active skill was worth less, and therefore fewer active managers were able to outperform. I think we're, my God, Dean, we're on schedule. I think we are anyway. And this is really all I have prepared for you. We're happy to take questions, and I know the Kernel people would happily take questions too.